Going to be officially the very first class that we are getting started as a part of the FM Success Batch for December 25. Just a quick thing that I would like to tell you people before we get started. I would really appreciate if you all turn on your videos so that we can have a more of an interactive session. I could have simply had a recorded batch, but because I wanted to have the interaction, I wanted to see you all be interactive as possible. So I would appreciate if most of you at least try to turn on your video cameras so that we can have a live interactive feel of a session. Um, all right, I'll allow you people some time to do that. In the meantime, this session, according to the schedule that I had shared with you, is supposed to be the one where we get an introduction about the FM, the strategies and the mistakes to avoid, the tips to do better. I've already shared in yesterday's session where it was the how to pass session, the orientation session for you people. So here in today's session, we are continuing one step further. We will talk a little bit more about the exam, what all is there as a part of the FM syllabus, and then we are going to proceed further to how we are going to move ahead with our course, and then ultimately we will start off with probably the first chapter of the syllabus. Let's see how the flow of the session goes. So I have in plan. Yes, Umar, we did have yesterday's session recorded. The recording of the same has also been uploaded on the YouTube channel, and it will also be there on the learning portal, which you people have been granted access to. So nothing to be worried about. All right, so let us get started for today. As you can see in front of you, here we are delving a little bit deeper into your ACCA FM exam. So you all know, for those who are, already done with a few of the skill level papers in ACCA, you people would already be familiar with it. But just for the ones who are appearing it for the first time, this is what the structure of the paper looks like. So this is basically going to be a 3 hour examination. You're going to get 3 hours exactly to answer the questions. Ideally, the time of the paper that you get is 3 hours and 15 minutes, but those 15 minutes are there for your instruction reading. You're not exactly allowed to read the questions in the question paper, nor are you allowed to answer those questions in those 15 minutes. So for the exam, you essentially get 3 hours, which if you translate, it comes out to 180 minutes that you get to solve marks of 100 marks of paper. So that means for every mark in the paper, you have got 1.8 minutes. The ratio becomes 1.8 minutes per mark. What does that mean? That for each and every mark of question that you're solving, so if it's a two-marker question, you've got roughly 3.5 minutes to solve that particular question. If you're taking more than that amount of time, then you are supposed to move ahead. You will not be spending more time over there. So this is about the duration of the exam. Second thing is you will be given 10 to 15 minutes to read the exam instructions. So just to be familiar with the software that is going to be there in the exam, we will already be familiar with the software. How will that happen? Because we will be practicing a lots and lots of past papers as well as the mock exams over the ACCA practice platform. So the ACCA practice platform is one such resource which you get complimentary from the side of ACCA once you enroll with ACCA. So once you register as a student with ACCA, you get the access to this ACCA practice platform. The access is very easy. You just have to use your credentials, your My ACCA ID, along with the password that you set for yourself. Same login ID and password you can use to log in into the ACCA practice platform also. So because we will be getting familiar with the practice platform, we will not be spending too much time in the exam to understand the software because we will already be aware about the software. Then, yesterday also, we had a quick overview about your paper. Your entire 100 marks of paper is going to be divided into three sections. Section A is 15 objective test questions of 2 marks each. So 15 times 2. Total, it is going to carry 30 marks of your exam. These are going to be separate independent questions. Question number one will not be related to question number two. And this is how it is going to work around. I think somebody's microphone is on unmute. Please keep your microphones muted so that we do not have any disturbances. All right. So I was talking about how we are going to have different questions. Question number one is going to be different from question number two. There's not going to be any link. So these are all going to be independent questions. Then you will have section B where you will have three case studies. Three case studies will be given to you. Within each case study, you're going to have five objective type questions. So five objective type questions, each case study, you are going to have 15 questions in total over here also, which is going to again contribute towards 30 marks in total out of your 100 marks of paper. Then the last part of your paper will be section C, where you have CRQs. CRQs are constructed response questions. So here you have to construct your answer from the very scratch, as the name itself is telling you. So whatever it is, if it's a discussion-based requirement, a word processor will be given to you. If it's a numerical-based requirement, Excel type of a spreadsheet will be given to you in the exam software. Once we proceed further, you will become more familiar with the software. So we are going to have two case studies basis that. So one case study will be for 20 marks. So in total, it is for 40 marks. That means 30 plus 30 plus 40 will make up for the 100 total marks of your paper. So this is how your paper is actually structured. Just one more very important thing which people should actually take a note of is that all of the questions are going to be compulsory. What do we mean by the questions being compulsory is that if you talk about probably your university exams, sometimes we do get choices. I personally did my graduation from one of the bachelor's degrees from Delhi University. So there we have lots and lots of choices. Internal choices are given. Solve this question. There's a big or written in the middle, or you can solve the below question. So it's a choice. But when it comes to the ACCA exams, all of the questions are compulsory. That means there are no internal choices. Whatever question has come up in the exam, you have to attempt it as it is. There is no other choice. Whatever marks it is carrying, if you get it right, you will get those marks. If you do not, then those marks are going to go away. Another very important thing to note is when it comes to your section A and B kind of questions, where each question carries 2 marks, sometimes what can happen is there will be two statements, statement number one, statement number two, where you will have to mark them true or false. So if let's suppose the answer that you have marked was both statements as true, now, when it goes towards the evaluation, I told you already people yesterday that section A and B are auto marked. They are marked by a software, by the computer. So that means there's zero involvement over here. How is this system trained to mark your answer is, if let's suppose the first answer true, that's the correct answer. But the second statement, you should have marked false, but you have marked it true. So now your second answer is incorrect. So do you people know, will you be getting 1 mark out of the 2 marks available or not? Do you people know that? Zero. Absolutely correct, Manya. So even if one out of the two is correct, still you end up getting zero because it is either two or zero in your actual exam. So you have to get both of the answers correct. Only then the full marks will be given to you. Even if you get partial correct answers, 0 marks are awarded for the partially correct answers. So this is how the marking scheme primarily works. This is the structure of your paper, and the nature of the questions is that they are all compulsory. So this is pretty much about what your final exam day is probably going to look like when it comes to the structure of the paper, how you're supposed to attempt the paper. This is what it will look like. Anything that you people would like to ask still here, anything that's bothering you, and even if it's a small little query, do not hesitate in asking. Anything that you would like to clarify here? You're all with me? Okay, perfect. So I will now proceed further to tell you people about what all are we going to learn as a part of the FM syllabus. So if you see ACCA themselves, this snip that I've taken, this is from the ACCA syllabus itself. They have themselves divided your paper into these broad syllabus area, A, B, C, D, E, F, and G. Syllabus area H, you can completely ignore. This is employability and technology skills. There is no separate syllabus for this part of the paper. This is just you getting to learn your spreadsheet, your word processor, because employability means will you be able to actually work for an employer in the future? So in the real corporate workplaces, we actually use the word processors, we use the spreadsheet files. So whatever we are going to learn as a part of the remaining portions of the syllabus, this employability and technology skills is automatically going to be covered. So there is no separate syllabus per se for this syllabus area H. We are going to lay our emphasis right from syllabus area A to syllabus area G, right? So this is all that we are going to study as part of the syllabus. Now we will break down the units one by one. So I'll tell you briefly what all we are going to learn in each of these units. So firstly, you see the financial management function. So financial management is a function that we perform in the entire organization. If you people are already students of commerce, you people would already be familiar that we have functions in the organization. What all functions do we have in the companies? Can anyone name a few examples? What all departments or what all functions do you see in any company? Okay, we have the HR department, all right, audit department. What else? Do we have sales? Do we have marketing? Do we have production? These are all operations, payroll. Exactly. Payroll and HR can be combined also. Finance department. Absolutely correct, you guys. So these are the different functions that we have in the organization. Because in the organization, we are doing all sorts of work. So different people are taking care of different work areas. So financial management is also one such function which is performed in the organization. So here we are going to learn that what is the role of financial management? Why do we need it? Why do we do it? What do we want to achieve while we are doing financial management? So here we are going to learn about the core idea behind financial management. Why is it needed? And what is our aim when we are using financial management? Then we are going to learn all about the financial management environment. So if I talk to you about the syllabus, this is practically chapter one of your syllabus. As soon as we are done with the first chapter, syllabus area A is going to be completed. Then if I talk about syllabus area B, this is primarily chapter 2 of your syllabus. So here the terminology that you see is financial management environment. What do we mean by the environment, guys? You people would already be familiar with this term. What is the meaning of environment? Yes, what does environment mean? Okay, workspace. Anyone else? What's the meaning of environment? Okay, we talk about internal as well as external factors. Perfect. So, environment, if I have to tell it to you in an even simpler word, environment basically means my surroundings. So, if I am operating as a business, let's suppose you are Domino's Pizza, all right? So, the work that you do is that you manufacture pizzas and you sell it to the customers. So, this is your main business. But is it only your customers and you who's going to affect the operations of Domino's? No, there are so many external factors. What our competitors are doing? What are the rules that the government is launching? What is the state of the economy? Because if the economy goes in a depression, will the people still be coming out for those expensive pizzas? Probably lesser, right? So, whatever is happening inside as well as outside of the environment of the organization, that is what forms a part of the environment. So, here in chapter number 2, this is going to be the biggest chapter of your syllabus. I'm warning you people in advance. It's totally, completely discussion based. There are no numbers over here in this chapter. So students also, get a lot worried when they see this chapter that it's such a lengthy one and then there is no numerical. So a lot of students lose interest because it's not numerical. But do not worry. I have the way that I have structured the classes, we are going to divide it into small chunks and we are going to continue with our syllabus as it is. Each and every class, we are going to study small portions of it so that you people will also be able to remember many things at the same time and also you'll not be getting bored about it. So this is what we are going to learn in the financial management environment. It will be everything about the surroundings of the environment, how an organization can be affected from internal as well as external factors. This is what we are going to learn in financial management environment. Then, if I talk about the third syllabus area, which is the working capital management, how many of you have heard the term working capital before? Or if you people know the definition or the formula or any terminology that you're aware about that could be the meaning of working capital. Have you people heard this term before? Working capital? Okay, perfect. A lot of you already know. Absolutely. This is current assets minus current liabilities, where you say that this is the money that is used for the day-to-day operations. Absolutely correct, Samanvai. So this means what is the money that I'm holding in the business for the day-to-day operations. So the formula that we have learned is current assets minus current liabilities. Now, within this particular unit, we are going to delve deeper into why it is important for a company to manage its current assets and current liabilities. Within current assets and current liabilities, also, we will break down the components. What are my current assets made of? It's cash, it's inventory, it's trade receivables. If I talk about my current liabilities, I have the trade payables. So these are a few things which we are going to individually learn about. If you have a look at the syllabus, we are for all the content that we are going to learn, we are going to follow the ACCA Study Hub as well as the ACCA official content delivery slides. So we are going to do a mix and match of both. So we are going to study from the ACCA official resources all the way. So in the syllabus that you people have, you have different chapters for different components of the working capital. One chapter is there for cash, one chapter is there for inventory, one chapter is there for receivables, and one for payables. So each chapter we will delve deeper into how should organizations manage each of the components of the working capital. Then we are going to move towards the syllabus area F, which will be syllabus area D, which will be the investment appraisal. Investment appraisal comes from two words. One is investment, another one is appraisal. Guys, what does the term investment mean? What is an investment? In simple words, if you have to explain, let's suppose to a child, what is an investment? The best way to understand whether you are able to understand the concept or not is if you are able to explain it to a small child, right? Because if you're able to explain it to somebody who does not have a lot of sense, that means you yourself know the concept really well. Okay, Hitanshu says something which can give you good returns. Obviously, whenever I'm making any investment, investment is you putting in money to generate some return on it. That return could be in the form of interest, it could be in the form of dividends, it could be in the form of profits, anything which basically helps you make more money on your money. So you would have heard that saying, a lot of people say, make your money work for you. Do not let it sit idle. Yes, exactly. You save, and with that saving, you put it into an asset which gives you a return. That is what it is, an investment. Now, each and every business that you come across on planet Earth, if it is a business, if it's a for profit company, then the entire perspective, entire reason why the company exists is to make money, is to make profits. So all businesses have investments which can help them give the return. So that investment, how are you going to find out where should we make these investments? That is what you're going to learn as a part of this chapter. Do you people know the meaning of the term appraisal? Some of you might even be working somewhere, so you would have heard that word over there. The job appraisal is happening, performance appraisal is happening. What is the meaning of the word appraisal? Yes, absolutely correct, Kia. It is like an assessment. So assessment means you're trying to find out that which person has done a good performance. Here we are talking about investment appraisal. So we will find out that, in the real world, organizations have limited amount of money, and there are so many options available to invest. You can invest in real estate, you can invest in precious metals like gold, silver, you can probably invest in the stock market, you can probably invest in debt market. So there are so many assets which are possible which I can purchase. Now, which asset is going to be the best for the business? That is what we find out using investment appraisal. So, this particular unit, you're going to learn more about how can organizations decide that which investment will be the best investment for the organization. So we will be learning different techniques here in this unit. You will learn techniques like net present value, NPV, internal rate of return, which is in short called as the IRR. Lots and lots of techniques we will be learning, which the businesses use to find out which project should be taken up by the business. This is what is the investment appraisal unit all about. Then, if you see the syllabus area E, the name of the syllabus area E is business finance. Finance, what do you people understand by the term finance? You're all sitting in the class of FM, financial management. Do you people know the meaning of the term finance? In simple words, what's the meaning of finance, guys? Come on, guys, be participative. Absolutely. Fund required for the business, cash or funds to operate. Yes, you're all correct. If I just have to write finance in one simple term, it's basically money. It's the money that you use to run. If you say business finance, it's the money that you use to run your business. Absolutely correct, Umar. So, here in business finance, you are going to learn that businesses have different ways of raising money for the business. Now, if I have to set up a business, the very first thing that I need to set up any business is the capital, the money. So let's suppose I have decided to open a plant where I will manufacture water bottles. So in that water bottle manufacturing plant, I will need plant and equipment. I will need the people to do the work. So all of this is going to require money from my side. I will have to do the research. I will have to develop a process. I will have to buy the machinery. So all of these things will require money, which is capital, which is finance. Now, if I, as a company, want to start up my own business, if let's suppose I'm only an entrepreneur right now and I want to start a business, so I need money. So, what are the options that I have so that I can bring that money? The options can primarily be divided into two parts. One is equity, another is debt. Debt, I'm sure you all will be already familiar with. Another word for debt is loan. So I can go out to a bank to take a loan. I can issue something that you call as debentures, which can also be a part of the debt capital. Another thing, another option which I have with me is the equity capital. What is equity capital? You go out to the public and you offer them to buy a portion of your company. So if somebody invests equity in your company, they just are not giving you money. In return for giving that money, they also get a stake, a part of the ownership in the company. So a company will have multiple options always, debt as well as equity. Within debt and equity also, we have multiple sources. So within this unit, we will delve deeper into what all options are available and then how the business will decide which option is going to be the best for them. No money. Nobody is going to give you money anytime in your life. Remember this thing for life. No one is going to give you money without the expectation of getting a return out of it. So, either let's suppose you take out a loan, you have to pay interest on it. If you take out money on equity, you have to deliver returns to your shareholders. Returns are in the form of dividends, they are in the form of growth in capital. So, if I invest 100 rupees, the share price should also keep on increasing and the company should also keep giving me dividends. So that is the return which the equity shareholders are going to be expecting. So different returns of these holders are going to be the cost for the company. So different thing has a different cost. So we will learn that which source should a company use depending upon what are the requirements, what is the cost that the company is willing to pay for the same. So this is what we are going to learn as a part of the business finance unit. Next, you have the syllabus area F, which is the business valuations. So here the key term is valuations. Do you people know the meaning of valuation or value? What could be valuation? Um, Not exactly appraisal. Kia is on the right track. You try to find out the worth of something. Valuation means how much is the value? What is the value of something? So here we are talking about business valuation. That means I'm trying to find out that what is the value of the business. So you people would probably be familiar with the terms like mergers, like acquisitions. So brands, what do they do is that they keep acquiring. So if it's a big company, they are looking for smaller companies to acquire. So, if companies come together, then it is called as a merger that you see happening. So, for all of these transactions, if you want to buy something, if you want to buy another company, is it really possible to buy a company without knowing its value? No. So here in this unit, you're going to learn how to value a company. If you want to buy a company, if you want to sell a small part of your own company, so that is why you should be knowing how to find out the value of the company. So valuation is the unit where we are going to learn deeper into this part. And then if you see finally the last syllabus area that you have is risk management. What do you people understand by the term risk? What's the meaning of risk? Okay. Others also can participate. Participation is free. You do not have to pay anything extra to participate. All right, I see multiple answers. You people are saying uncertainty or losses happening, mishappening, chances that something goes wrong. Absolutely correct. You're all thinking on the same lines. So, whenever you talk about any business, there's a possibility of risk always there. Risk means that something is going to happen which will not be probably in your favor, which will probably be not what you want. So, if I talk about a scenario like the COVID-19 pandemic, so for majority of the industries, it was a really bad thing to happen. Why? If you talk about the hotel business, if you talk about the travel and tourism industry, the aviation industry, these were the industries which were the worst hit by COVID. So they were facing the risk of losing out their business because of these things happening. The lockdown was there, so nobody was taking flights. So these businesses were having the possibilities of making losses, things not going their way because of the changes happening in the environment. Risk can be favorable also. It can affect you positively also. It can affect you negatively also. So the same COVID example, like how I'm telling you, that the people in the aviation industry, tourism industry, travel industry, they were all negatively affected. But can you think of somebody who benefited in this scenario? Which industry had actually a boom during the time of COVID? Who will tell me? Absolutely correct, Nidhi. It was the healthcare, the hospitals industry. Hospitals were booming, boosting with profits. The pharmaceutical industries, the companies who were manufacturing the medicines, absolutely correct. The pharmacies, the nurses, the doctors, these industry, the healthcare workers, they were actually being paid a lot. Absolutely. Online classes also saw a very good increase during the COVID-19 pandemic because the people could not step out of their houses, but learning should never stop. So people switched to online learning. Also, we saw school classes going on online, we saw college classes going online. Professional qualification, ACCA, we are still studying online because it's a borderless qualification. Then you see OTT platforms, very good. Social media that got a boost. Cinemas were adversely affected. So you see how things happen in the external environment and they can cause good things or bad things to happen for a particular business. Now, whenever a business is starting up, risk is something which can never totally go away. But if you take precautions, if you take care in advance, the bad effect of these things can actually be minimized. So, if I talk about for a human being, if we are worried about another pandemic happening, can you think of any reason that we can protect ourselves from it a little bit? Anything that we can do to protect ourselves from a pandemic or any health condition? When COVID happened, what did we do as a response to it? Okay, all right, perfect. Vaccines. We developed a vaccine which helped us to prevent the disease from happening to us. We were spreading awareness among the people. Safeguards were in place. We were using hand sanitizers. We were covering our face with masks in the public places. What else can we do? You people are forgetting one very important finance thing. Insurance, absolutely correct. So, insurance is something, even if a bad thing happens to you, the impact of it can be minimized. It can be mitigated with the help of insurance. You keep paying small amount of premium so that one day if something goes wrong, and you all know how expensive healthcare is becoming. In the developed nations, it's already quite expensive, but there the governments keep paying the bills. But here, if you talk about developing countries like India, Pakistan, Nepal, Sri Lanka, all of these countries, you're seeing how the healthcare industry is becoming more and more expensive for the common people. So, what is one thing that we can do to afford good quality healthcare is we can opt for insurance. So we pay small premium so that one day, if God forbid something bad happens, we do not have to worry about the money because the insurance company is going to take care of all of the bills that we have to pay. So this is one way that we can protect ourselves a little bit from the bad thing which is going to happen to us. So in the context of a business also, we will see that there are multiple things which can go wrong with the business. Particularly in the FM syllabus, we have two sorts of risks which we will learn to mitigate. One is your interest rate risk, another is your foreign currency risk. So there are multiple businesses who will be operating throughout majority of the countries around the world. If I am, let's suppose, setting up a business here in India, maybe I have my suppliers in China, maybe I have my suppliers in UK, maybe I have my customers in the US. So if I am doing a business on a global scale, what happens is there will be exchange of multiple currencies. Here in India, we work the Indian rupee. In China, we have the Chinese yuan. In UK, we have the sterling pound, GBP. In United States of America, we have the US dollar. So if I am receiving payments in different currencies, I have to make the payments in different currencies to my suppliers. So then there are always chances because what keeps happening, the foreign exchange rates keep on changing. For example, you people, if you are based in any other country apart from the UK, whenever you pay your fees to ACCA, that fees is invoiced to you in terms of GBP. So you have to convert your domestic currency wherever you're located. If you're here in India, you convert your rupees into the pounds to give the payment to ACCA in sterling pounds. So when you convert, sometimes the rate of pound will be an X particular amount. Next time when you're making the payment, it could have been more, it could have been less. Also, we see that the pound keeps on appreciating against the rupee. We have to keep paying more and more rupees to get the same amount of pounds. So this thing can also be a bad impact on the business if you are on the payment side. If your currency keeps on weakening, you have to pay more and more of your domestic currency to buy the foreign currency. Vice versa will be the scenario if you're on the receiving end. So if somebody is supposed to send you 100 pounds from UK, the more your currency depreciates, the more money you will receive once you translate it into your own currency. So we will come deeper into this particular part of the syllabus when we reach over here. And the second aspect of risk which we have as a part of our syllabus is the interest rate management. What do I mean by the interest rate management? Sometimes the company will already know that today we are standing on the 15th of September. 6 months from now, exactly 6 months later, I have to borrow money from the bank. So what would be my fear here? If I am on the borrowing side, I have to pay interest on the borrowings that I make. So if today the bank interest that they are charging is, let's suppose, 10%. 10% is the rate of interest that banks charge today. I know that I have to take a loan 6 months later. So my biggest fear will be if I take a loan today, it's going to cost me 10%. But maybe 6 months later, the interest rates increase and I might have to pay 12%. This interest is a cost for me. So my fear will be an increase in my cost. Vice versa, if I'm on the investing side, I know that 6 months later, I'm going to receive a very big payment. Today, the interest rates in the economy for deposit are 10%. But my fear would be that till the time I get the money in 6 months and when I take it to the bank to invest, maybe this interest rate falls to 8%. So today I can get a return of 10%. but maybe later I only get 8%. So in these scenarios where I have to deal with interest risk, I have to probably borrow in the future, I have to invest in the future. So, how am I going to deal with this particular risk? These are the two things which we have as a part of the ACCA FM syllabus, which we will be learning in this particular unit. So, this was a brief overview about what all we are going to learn as a part of the ACCA FM syllabus. Although this is just a summary overview which I have given to you people, still, if you have anything to ask till here, I am allowing you some time to do so. Otherwise, if there is nothing, then we are going to proceed further. I will tell you how we are going to study as a part of this success batch. And then eventually, we are going to proceed further to one of the chapters that we start with. So let me know if you have any queries still here. Even if what I've told you about the syllabus does not make 100% sense to you, it is totally okay. This is just to give you an overview that this is all what is there in store for you in the FM paper. And it's nothing difficult, no rocket science. Trust me, if you have, if you participate with me in the classes, if you listen to me actively, it's all going to be a piece of cake for you. Nothing difficult is there in the FM syllabus. Let me know if you're all with me till here. Any concerns? Others? Okay. All right. Great. I will now tell you people what is going to be the approach that we follow in this FM success batch. So when we get started with the syllabus, the very first step will be that I will complete each and every chapter with you. So concept by concept, we will be covering the entire syllabus. Secondly, whenever we are done with the syllabus, what we are going to do is we will head to the ACCA Study Hub and we will solve the Study Hub quiz, which is there after every chapter on the ACCA Study Hub together with each other so that we will be able to understand whether or not we have understood the chapter that we have studied in the class. Third thing is that I am going to give you a targeted homework. That means once we are done with the chapter in the class, as soon as one chapter gets finished, we do the quiz in the class itself. And then on the ACCA Study Hub, we have one more section, which is called as the practice section. In that section also, we have the chapter-wise questions given. So once we are done with the chapter and we solve the quiz together, your homework, without even me saying, automatically becomes to practice the question bank for that particular chapter on your own and bring in any queries, any amount of queries that you have, be it the smallest of the queries that you have, either in the next class or via WhatsApp group or message me personally over the WhatsApp and I will be resolving each and every query that you people have. If needed, I will take up the question live also. If there's a particular difficulty, if the concepts are typical, then I will take it up in the live sessions also. But the idea is you people should be getting into the habit of practicing because in the final exam, unfortunately, I will not be there with you. So you have to get into the habit of solving things on your own. Then you are going to go through a guided question practice. So that means as soon when we are done with the syllabus, I will let you people know what all question numbers can you practice from the BPP kit so that you do not end up wasting your time. As in when we are doing the portions of the syllabus, whatever portions we are completing, I will let you know that this question number till this question number, these are the questions that you can practice based on the concepts that we have covered till now so that your practice will also go hand in hand along with the concept coverage. Then the next thing which is there in store for you is the unit-wise test series, which is also the Being ACCA test series. What happens over here is your syllabus has been divided into different units as we've just seen above. So as and when one unit of the syllabus is done, you will be given with the test for that particular unit. The dates are going to be shared with you in advance. After today's session, I'll share the dates of all of the tests with you. And as per our syllabus coverage, after allowing you people sufficient time for your practice, then we will be holding this test where this is going to be a freshly prepared question. No question from any of the kids, no questions from any of the past papers, just questions which I have prepared myself from scratch for you people in accordance with the latest exam standards as well as my past experience. So you will be solving those questions. And then we are also going to have an evaluation. I will personally be evaluating those questions for you. And then we will also be debriefing those tests to learn how to step by step solve the answers. There's one doubt asked by Umar. Do we need to purchase the BPP kit? No, you do not need to purchase it. I will be sharing the soft copy with you. Although the choice of whether do you want to use a soft copy or a hard copy is dependent upon you people, those of you who are studying. But my suggestion by default is that you people do not go for the hard copies. Why? Because ultimately your final exam has to happen over a computer. So you should be getting into the habit of studying and practicing over a computer itself. This is especially important for our Asian students. Why? Because we are in very much habit of doing everything on pen and paper. Our school, our college, everything happens on pen and paper. So once we are switching to the international qualification like ACCA, we have to adapt to this computer format. So it becomes very important that we practice and study also over the computer itself. All right, Omar, I'll share the soft copies of the kits with you people post this session. Then I was telling you people we are going to have the test series, the Being ACCA test series. Once we are through with all of the tests for all of the concepts as well as the units, what we are going to do is the past paper practice. So I told you in yesterday's session also that past papers are very important. So the most recent past papers, last 3 to 5 years, we are going to practice together so that you people get confident. Why are these questions going to give you confidence? Because these are questions which came up in the real ACCA exams not very long back. So they give you the latest practice. What are the questions that the examiners have been asking recently? You will be getting a practice of that. So once you practice those questions on your own, you will definitely feel more confident that yes, you will be able to solve whatever comes up in your final exam also. Then we are going to also have some of the sessions where we will focus on exam technique. So I will tell you how to manage your time, how to structure your answers, and how can you maximize your marks in the requirements. So smart mark scoring tips will also be given to you people. Then we will also be having doubt clearing sessions as and when required. Whatever doubts that you people have, I will keep resolving those queries over WhatsApp. And if needed, we will also have sessions to clear up your doubts so that there are no gaps in your understanding. Then ultimately, we will be having a final revision along with the mock exam. So we will revise each and every chapter from the syllabus together. And then there's going to be the mock evaluations also, where I will be evaluating full exam time, 3 hours of 100 marks of paper, mocks for you people, so that you get to know where you're making the mistakes. Any mistakes you people make in the mock exam itself, so that those mistakes are not repeated in your final ACCA exams and you save on those mistakes over there in your final exam. So this is what is going to be our approach when it comes to this success batch for December. Any queries still here? Are you all with me? Perfect. Great. So are you people ready to now get started with the syllabus? Should we get started? All right. The planner for the paper is going to be shared with on the portal itself. Umar is asking, will you be using Kaplan or solely BPP? So, Umar, this is something which I mentioned yesterday also. The content that we are going to be using, content will be strictly the ACCA content, which will be the study hub, as well as the slides which the ACCA gives. And then when it comes to the practice portion, I told you people that there are two most important resources when it comes to the practice. What are the two most important resources? Number one is your BPP kit. Second is your ACCA study hub. So if you are done with all questions that are there in both of these resources and you are still left with time, then you will move to the Kaplan kit. Because I told you the reason also yesterday. The reason is that the level of difficulty that you see in the Kaplan kit is a lot easier than what comes up in your final exam. So I do not want you to practice easy questions and think, wow, I know everything. I do not want you people to be overconfident. BPP kit is the kit which gives you the level of questions which actually come up in your final exam. So I want you people to get the practice of the real exam like questions which are there in the BPP kit as well as the study hub. So these are the two primary resources that we will be sticking with in terms of practice. If you get the time, then definitely you can go to the Kaplan kit also. There's one doubt. I have completed my MCOM in 2017 and have been working in an audit role within a not-for-profit organization since then. I'm interested in pursuing ACCA, but since it's been 8 years since my studies, I've forgotten many academic concepts. Will it be possible to pass if I join the ACCA? See, the zeal to learn actually has to come from within you. It does not matter how much time it has been, until and unless you really want to learn, if you really have that zeal inside you that, yes, I want to learn something, then definitely you can be catching up. It's not something that you've not already done before. It's just that it's been a lot of time, so you're not able to have everything on the top of your head. But obviously, once you revise, once you study those things again, everything is going to come back to you. So this totally depends upon you. Do you have that willingness to learn? If yes, then absolutely nothing is impossible. All right. So are you all ready to finally now get started with your actual syllabus? Wow, perfect example given by Levin. He completed his graduation in 2008, restarted studies in 2023. FR was the paper that he last attempted, and he topped the country in that paper. So this is totally upon you. If you have the zeal to learn, nothing is impossible. Age and all of these years, they're just numbers. If you really are interested, if it's something which you are passionate about, nothing can really stop you. So before I take you people to the syllabus, I will just to the actual chapter that we are going to get started with. I would just like to show you people the ACCA Study Hub, especially for the ones who are going to be attempting this paper as the very first skill level paper. So this is what your ACCA Study Hub is going to look like for your exam. Please do not annotate over here on the screen. Okay. So these are the syllabus chapters which the ACCA has provided to us over here. 19 chapters are there in total. 1 to 19, these are all the different chapters which we have as a part of the syllabus. Here we have flashcards. Flashcards will be primarily useful for you people when it is the time of revision. So here the key concepts are given along with their definitions. So this is the word financial management. This is the definition of financial management. So you have 76 flashcards, which if you are in a revision mode of the paper, so these cards can be useful for you for the revision part of it. Then, like I was telling you people, after every chapter, we have the quizzes given to us. So 19 chapters are there. For each of the 19 chapters, we have the quizzes given to us. Each quiz is consisting of 5 questions, right? And then you have the practice portions also. So for each of the chapters, you have the OT, objective type questions. And for the chapters that get tested in section C, you will also see the constructed response practice part. So here you will be given with section C type of questions to practice, the full 20 marks of questions to practice on your own. So this is briefly a walkthrough of what your ACCA Study Hub looks like and what are the resources which you people should be using. So the very first chapter which we are going to get started with is going to be chapter number 19. You people might be thinking, and you rightly so, that why are we starting with the last chapter of the syllabus? We have 1 to 19, 19 is the last. Why are we starting with the last chapter? That must be the question that you're getting. So, the reason behind this is that the chapter number 19 is something which most of you would already be knowing. It is just something which we will learn how to solve these numbers over here. The formulas, I'm sure most of you, since you are doing your ACCA, you're all commerce students, so you would be very much familiar about the ratios that we are going to learn as a part of this chapter. So this is one chapter that we can very quickly get done with, and then we will delve into the chapter number one, which is going to be the introduction of the FM. So it's going to be all about why do we need FM, what is FM, and what do we want to achieve with FM. So the very first chapter that we are getting started with is chapter number 19, and I'll show you how easy everything is. Just let me switch my screen back to the slides. So here I have chapter number 19 for all of you. Just to give you a brief overview of what all are the different categories of ratios are we going to learn over here. Firstly, let's understand that this chapter, the name of the chapter consists of two terms. One is ratio, second is analysis. Ratio means when you try to see one variable as a proportion of another variable. So how many sales have I done and how much profit have I generated on that sale? So that's a ratio. And then what do people understand by the term analysis? What does analysis mean, guys? What's the meaning of analysis? Okay, a review, comparing. All right. So analysis means you're trying to understand the reasons why something is looking like a particular manner. Likhna is also correct, deep understanding. So you do an analysis, you try to go and investigate in detail that why this particular ratio is looking like this. So what all different ratios we are going to learn, different ratios have been divided category wise. So basis what we measure as a part of that ratio, we have divided different categories of the ratios. First is the profitability category. Second category is liquidity. Third is efficiency. Fourth is the risk. And the fifth is the investor ratios. So these are the different kinds of ratios basis on what they measure. The name itself is telling you what the ratio is trying to measure. So the very first category that we are going to learn about is the profitability ratio. So profitability comes from the word profit. So here all the ratios that fall in this category will be measuring how much profit the business has generated. So if you see the very first ratio that we have as a part of the profitability ratio is the GP margin ratio. So the formula for that is you take the gross profit, you divide that by the sales, multiply by 100. That means your final answer will always be given in a percentage. So if I tell you people that what this ratio is exactly trying to measure, let's suppose we have a stall where we are selling lemonade. All right, so we have a stall where we are selling lemonade. Now, if I want to measure how much is the money that is left with me after subtracting all of my raw materials. So when I'm making lemonade, what all raw material will I need? I will need lemons. I will need water. I will need sugar. So these are the primary raw materials that I will need. Now, if let's suppose the sales that I have done is $100 and the raw material had costed me $60. So that means my gross profit is going to look like, what is the formula for GP? GP is sales minus cost of goods sold. So my sales is 100, my cost is 60. So that means my gross profit is 40. I will divide that by the sales, which is 100. I will multiply this by 100. So that will give me 40% as my GP margin ratio. So I will get to know that once I pay up for all of my direct expenses, I am left with 40% of the sales value. So this is the explanation for the first ratio. Then the second ratio is your operating profit margin. So here we are measuring that after subtracting for all sorts of expenses. Till here I had only subtracted the direct expenses. But the businesses also incur some of the indirect expenses like rent, like depreciation, like if you talk about the admin office, the admin staff, the electricity of the admin office. So all of these expenses, once I take away literally everything that has been spent over the business, what is the money that I am left with? So let's suppose my extra expenses are $20. So now I am left with 60 plus 20, 80 are my total expenses. 100 is my sales. That means 100 minus 80 will give me 20. 20 upon 100 into 100 will give me 20% as my operating profit margin. That means for every $100 that I sell to the customers, $20 are left with me after subtracting each and everything that I have to spend money upon. Then the third ratio that you see is the return on capital employed. The formula for this you see is PBIT. PBIT is also in other terms called as operating profit. So do not get confused. They are both representing the same thing. Operating profit and PBIT are interchangeable terms. So once you divide the PBIT with the capital employed, that gives you the return on capital employed. Would anyone like to tell me the interpretation of this ratio? What do we calculate using the ratio? What do we find out on calculating the return on capital employed? Yes, how much is the return on the money that you have invested in the business? So if let's suppose I have assets in the business, I have invested in the business $1,000, and over those $1,000, my operating profit looks like 200. So that will give me 20% as the return on capital employed. Capital employed, there are two ways how you can calculate your capital employed. Either you can take the shareholders' funds and add long-term liabilities to it. Why are we adding the liabilities? Because the long-term liabilities will usually be the loan. Why does a business take a loan? Maybe to buy a machine, maybe to buy a building, maybe to buy a plant. So whatever money that you've taken on a loan, that money is also being utilized in the business. It is employed in the business. That is why you take the shareholders' funds, which is primarily your equity, and you add your long-term liabilities to it. Another way to calculate the capital employed is take the total of your assets. From that total, subtract your current liabilities. So this will also let you find out how much is the money that remains invested in the business throughout the year. So this is the capital employed two ways. Depending upon whichever information is given to you in the question, you can find out the capital employed using either of the formulae. Then another ratio which we have as a part of the profitability ratios is the return on equity. What is return on equity? Same as return on capital employed. It's just that in return on equity, you are just seeing that on the shareholders' equity, how much profit has been made. So in your denominator, you see your ordinary shareholders' funds. Your numerator is now going to be those profits which are left for your shareholders. So if you people know what is the hierarchy in which the company has to pay off the people externally, firstly, the company has to pay external creditors. So it could be the debt that the company has taken. So first, the creditors are paid off externally. Then the preference shares are paid off, and then the ordinary shares are paid off. So once literally everything has been paid off, if still money remains, then that money is what is left for your ordinary shareholders. So here, your numerator is profit after tax. So after every headache has been met with, after every expense has been deducted, still you subtract the preference dividend because they get preference over the normal shareholders. So after subtracting preference dividends, this is the amount of money which is remaining for the ordinary shareholders. So how much money have those ordinary shareholders made in a comparison to their original investment, which is the shareholders' funds? That is what the return on equity ratio actually tells you about. So these are the different ratios. These are four ratios that we have learned so far. Any queries that you people have till here? Anything that you want to get more clarity upon? All good? Perfect. Okay. Now I proceed further to one relationship that we have between the profit margin ratio, which is your operating margin, the ratio number two, which we have learned. If you multiply that by the asset turnover ratio, you get your return on capital employed. How is that possible? We will prove it with the formula. For the profit margin, we have seen that we get the formula PBIT upon sales. So I've written this formula as it is PBIT upon sales. Multiply this with the asset turnover. The formula for asset turnover is sales upon capital employed. So if you write them together, sales and sales get cancelled with each other. So you get PBIT upon capital employed, which is the exact formula of your ROCE. I have one query in the chat box. Which preference dividend, redeemable or non-redeemable? So we are going to go further into the detail of it when we actually learn the debt finance chapter. So there we see how redeemable preference shares are classified and how non-redeemable preference shares are classified. Because preference shares have characteristics of both the aspects. They have some characteristics of equity, some of debt. So there are different ways with which we have to treat them. Redeemable preference shares are treated differently. Non-redeemable are treated differently. But when it comes to your return on equity formula, all dividends that you pay to the preference shareholders, be it redeemable, be it non-redeemable, everything has to be subtracted. Whatever is left after that, Lekhna, that will be the profit which is available for the equity shareholders. Okay, perfect. So now continuing further, this is one relationship that you people can remember that if let's suppose you are given with two out of these three figures, you can use the two figures to find out the third figure, right? Now we will move ahead to the next category of ratios, which is the liquidity ratio. You can see the two ratios that we have as a part of this are right in front of you. These are the ratios which you are studying from the very basic of your commerce studies. But can somebody quickly let me know the meaning of liquidity? What does the word liquidity mean? You're all students of commerce, finance, accounting. What does liquidity mean? What's the meaning of liquidity? Exactly. How fast can you convert something into cash? How easily or how readily can an asset be converted into cash? So, how can you measure that the business is able to repay its liabilities on time? They are called as liquidity ratios. How solvent is the company? How liquid is the company? So, there are two ratios which we use to measure the liquidity of any company. First ratio is the current ratio. Second is the quick or the asset test ratio. The formulae are pretty simple. Current ratio, you take current assets upon current liabilities. What is the ideal ratio for a current ratio of any company? You people know that? What is the ideal current ratio? No, think again. Yes, live-in is correct. It is 2 is to 1. So you should, if let's suppose you owe $1 to the people outside of the company within this year, you should be having $2 as a part of your current assets to represent that, yes, I have enough capacity to pay my liabilities as and when they fall due. Then you have a stricter test of liquidity, which is called as the quick or the asset test ratio. What does this ratio tell you? That within your current assets, there is one asset which you have included, which is inventory. What is the inventory? This is the goods which the business sells as a part of the business. So what happens sometime is that inventory, it is not exactly possible to sell that inventory and convert it into cash very quickly. Why? Because sometimes there are some out of fashion items. Sometimes those items are so old that nobody wants to buy them. They are probably not in the trend right now. Maybe they got damaged because of being in inventory for so long. So what do we do is asset test ratio tells you that we will remove this asset. We will only include those assets which can be very quickly converted into cash. So as soon as a liability falls due, these assets are readily convertible into cash. So what do? We take the formula as it is, we just subtract the inventory from the numerator so that we are able to judge that even if the inventory is slow moving, do we have the capacity? Do we have enough other current assets to pay off our current liabilities on time or not? So this is what this particular ratio is going to measure for a particular company. Now, do you people know the ideal ratio for this one? What's the ideal current quick ratio or the acid test ratio? Yes, the answer for this is 1 is to 1. So if it is 1 is to 1 for a company, that means the company has enough capacity. It is sufficient to pay its current liabilities on time. So these are the liquidity ratios. Any queries still here? You're all with me? Okay. Now we proceed further to the third category of ratios, which is the efficiency or the activity ratios. So here, these all ratios relate to the activity of the business. What is the day-to-day activity? Trading, selling and buying of the things. So whatever you sell to somebody on credit, that person becomes your receivable. So receivables collection period is one ratio which measures how much time do you take to collect the payment from your customers? So, what usually are the brands offering? That you take the goods from us today on your credit card and you can keep paying the credit card installments. So, how do businesses sell? Sometimes the business is going to sell to a customer and they will say, you can pay us after 30 days, you can pay us after 40 days. So here with this ratio, we are actually finding out how much time does it take for the company to collect the money that the customers owe to the company. So here we are, the numerator is going to be what you're calculating, which is about the receivable. So numerator will be the receivable and the denominator will always be the reason why you have the numerator. Why do receivables exist? Because you sold something to your customers on credit. Just because you did not take the money right there when you made the sales, you have to take money from them in the future, because of which they become your receivables. So the reason why the business have receivables is because they do credit sales. So receivables will be your numerator. The reason why you have receivables will be the denominator, which will be credit sales. This way you will never forget the formula. Just always understand the logic. Here we are seeing that of the money that people owe to us, how much time do we take to collect that money? So you multiply that by 365 so that you will get your final answer in terms of number of days. So if let's suppose my receivables are 10 and then my annual credit sales are, let's suppose, 365. So here, if I multiply this by 365 days, I will get 10 days. So that means it takes me 10 days to collect my receivables from my customers. Then the second thing is about the payables payment period. So similar to the receivables, here we are measuring how much time do we take to pay our payables. What are payables? These are the balances that we owe to somebody else. So these may be our suppliers. We have bought things from them on credit. So now we have to pay them money after some time. So how many days do we take to make the payment to them? That is called as the payable payment period. So the formula logic remains the same. Numerator, what you're calculating, that is about the payables. Denominator is why you have the payable balance, because you purchase things on credit. You did not pay the money right back then. So now you have to pay the money later, which makes it a liability, which makes it a payable for you. So you multiply this by 365 so that you get your final answer in terms of number of days. Then same thing is with your third ratio, that is the inventory holding period, where the numerator is inventory. Why do you have inventory? Because you bought the raw material, you did the production process. So the cost of sales represents the money that you spent in building that inventory. So inventory divided by the cost of sales into 365 will give you, what does the inventory holding period represent? How much time did it take for the business? Let's suppose today on the 15th of September, I have manufactured my inventory. Now I do the final sales on 20th of September. So that means 5 days the goods were lying with me unsold. So 5 days is my inventory holding period. From the time with which they are ready till the time they are actually sold to the customers, the difference between that time is called as the inventory holding period. This is the amount of time that the business is holding the inventory with themselves. Then you have another ratio, which is nothing but a combination of these three ratios, which is the operating cycle. So this operating cycle is basically the time that the business takes right from the business has started incurring cost on raw material, on inventory, till the time they actually sell it to the customers and cash comes back to the business. This entire cycle is called as the operating cycle. How do we calculate this? You add the inventory days, you add the receivable days, and you subtract the payable days. So whatever are your current assets, you add them. Whatever are your current liabilities, you subtract them, and that will give you your operating cycle. Again, what is the definition of operating cycle? How much time does it take for the business once they spend cash till on raw materials, on the inventory and everything, till the time that they make the sales and the customers make the payment in cash to the business? That is the time that the operating cycle represents. So the shorter the operating cycle, that means cash comes back to the business quickly. That means it will be a good thing for the company. If it is a very long cycle, then that will mean more amount of money will be needed to sustain my operations till the time my original money is going to come back to me. So this is the operating cycle. Then you have the formula of asset turnover. Basically, you're measuring that on the capital that you have employed in the business, on all of the assets and all of the liabilities that you have taken to use in the business, how much sales have you been able to generate upon that? So if this number looks higher, the answer for this will always be represented in terms of times. So the higher the number, that means more productively you have been using your capital, which has been employed in the business. And one more ratio, which is lastly a part of the efficiency or the activity ratio, is your sales to working capital ratio. So here you see, in comparison of the working capital, how much sales are you making? So this will also be represented in terms of times. All right, so these are the efficiency or the activity ratios. These measure the activities of the business. Any doubts still here about the efficiency or activity ratios? Let me know. Then we will move to the next category. Please let me know any doubts. Okay. So I will move forward now to the next category of ratios, which is the gearing or the risk ratios. Gearing, what does this term represent? Gearing basically means debt in a company. So gearing can also be of two types. There is one which is financial gearing, which actually means debt. Another is operational gearing, which is actually about the fixed costs in the business. So the gearing is of two types. That is why the ratios also we have further divided into two types. Firstly, when I'm measuring the financial gearing, I am trying to find out that how much of a debt is there in the company. Firstly, before I explain the ratios that we have in this category, you people let me know, is it good if a company has too much debt in the capital structure? Is it a good thing for a company to have too much debt? No. Why is it not good? Can anyone give me the reason? Why is having too much debt a problem? Okay, more interest. What will happen if there's more interest? I'm looking for the specific answer. Exactly. Lesser profits, your profits can decline. What will be left for the shareholders can be lesser. Also, one more possibility is that if I have too much debt and my business is not doing well, if let's suppose I'm not even earning enough money to pay off my interest, I can go bankrupt. I can lead to liquidation. You're all correct over here. There is a possibility that the company can be declared bankrupt because we do not have enough money in our profits to pay off even the interest. Forget the capital repayment, we do not have enough money to repay the interest. So in that case, the company will go bankrupt, company will be liquidated, the assets will be sold, business will have to be stopped. So that is why having too much of debt is a problem for any company. So here with these ratios, we are trying to measure how much debt the company has in comparison to, in the first ratio, we are comparing debt to equity. In the second ratio, we are comparing debt to the total capital. So the first ratio, you people see the formula. The formula is non-current liabilities, which is nothing but a fancy word to say debt. This is the amount of loans that you have taken for a long period of time, which is debt. And you divide it by the equity. What all is a part of equity? Whatever is the shareholders' capital plus the reserves. Reserves is also technically the money which belongs to the shareholders. So your denominator is non-current liabilities divided by the total of equity, which is capital as well as reserves. So this is the first formula where you're comparing the proportion of debt to equity. Second formula, as the name itself is telling you, you're comparing the proportion of debt to the total capital. So here the numerator remains the same. It is the debt itself, which is the non-current liabilities, just the denominator changes. Over here in the first ratio, we were comparing to equity, so the denominator was equity. Here in the second ratio, we are comparing total capital, so the denominator is also the capital employed. So this is the money which remains invested in the business for the entire year. So these are the two ratios with which we measure how much debt a company has, how much financially geared is a company, how much leverage financially does a company have. So different industries are going to have different sorts of ratios. There are no ideal ratios when it comes to the financial gearing because these ratios vary a lot because of the nature of the business, nature of the industry, the type of business that they are doing. So a lot of factors are variable here. So we usually do an industry comparison or we just do a comparison that it should not be too much. It should not be 80% at 90% at. That should not be the case. It should be manageable levels of debt. So this will differ. The definition of manageable will differ from company to company. Then the next category that we have within the gearing category is the operational gearing ratio. So like I told you, operational gearing means how much is the proportion of our fixed cost in comparison to our total cost. So operational gearing, there are three formulae. Any three or any out of these three you can use unless they have not clearly told you in the question which one to use. All of these three formula will be marked correct if nothing has been mentioned. But if they have mentioned that you will use this formula, then only use that formula which they have mentioned in the question. So operational gearing is calculated as fixed cost upon variable cost. So FC upon VC, this is first formula. Second formula is you take the fixed cost and you divide by the total cost. So what is the total cost? Total cost will be fixed cost plus the variable cost. So the second formula is you take the fixed cost and you divide that by the total, which will be fixed as well as variable cost. And the third formula is you can also take it as contribution upon PBIT. So these are the three formulae which will let you know that if the company has, let's suppose, total of 100 costs, how much of that is a fixed cost? And what do you people think about the interpretation? Is it good if a company has very high fixed costs? Is it a good thing to have? Why is it not good? Why is it not good to have too many fixed costs? Exactly. If the company does not do good in a particular time frame, if our sales are not very much, there is a very good amount of possibility that we do not even make enough sales to be able to meet our fixed costs. That is why the proportion of fixed costs from the total should not be too high because in bad times of the business, there can be chances that the business is unable to meet the fixed costs also. This is about the operational gearing. And the third subcategory within these ratios is the risk ratios. So here they measure the risk that the company is facing. So first is the interest coverage ratio. So this ratio exactly measures that if a company has to pay an interest, let's suppose the interest expense of the company is $10 million dollars, and the profit that the company has generated is $100 million dollars. So can you people let me know that if I have to pay $10 with the $100 that I have earned, how many times can I pay these $10 to you? If I have $100 with me and I have to pay you $10, how many times can I pay these $10 to you people? 10 times. Absolutely correct. So this is what the interest coverage ratio measures. It measures how many times the company is in a capacity to meet the interest obligations that the company has to pay for. So the formula is PBIT upon interest expense. The answer is always denoted in terms of times. So here my answer is 10 times. That means I, as a company, I hold the capacity to pay the money 10 times to you. So the higher the number, it will mean more safer the company is, because they have more money to be able to repay the liabilities that they have. Liabilities are less and the money that the company has is more. So it is a safe company. The lesser the number, riskier it will be. Second is the cash flow coverage. So it is not the profit which is going to give the interest expenses. If I want to pay something, if I want to make a payment, my profit will not help. It is cash which will help me. Can you people let me know, is profit the same thing as cash? Can I say that if I have profit, I will have cash also? You're all saying no, you're all correct, but can you give me any example to tell me how are cash and profit different from each other? How are profit and cash different? Since you're all saying no, they are not the same. You're all telling me bookish terms. Can anyone give me a real life example? Because I can give you an example. Is there anyone who can think of a real life example? Whatever reasons you're giving, you may be satisfied with these reasons, but I am not. Still not satisfied. Okay, let me give you an explanation. So, if you want to understand the difference between cash and profit, this one very simple real life example, you will never forget the difference between cash and profit. So consider a scenario, you're all aware about the stock market, right? Even if you do not invest or trade, you will still know what the stock market is all about. So there are different shares of the company which trade on the market. So let's suppose what I did was I invested in a share which was worth $10. Okay, this was the price of one share, and I have purchased 1 million number of shares. Okay, this is the number of shares, this is the price per share. Now, what happened after I invested this money? My share investment was actually a very good decision that I did, because now the share price has actually increased to $30. So $30 is now the share price of the share which I actually purchased for $10. So how much profit have I made, guys? On one share, I've made a profit of 30 minus 10, which is $20. And I had invested 1 million number of shares. That means $20 million is the amount of profit that I have generated. But I tell you people also at the same time that I have not yet sold off these shares. These shares are still a part of my investment, and I am waiting that once the stock price will hit 35, then I will go out and sell these shares. So, am I in profit, guys? Have I made any profit till now? Yes, I am in a profit, but that profit is not realized. So I do not have any cash with me. If you come to me and tell me, ma'am, can you please give me $1 million? You've made so much of good profit. Just give me a small portion of it. Give me $1 million only. So what will I tell you? I have made a profit of 20 million, but I have zero cash. I do not have money with me right now. Why? Because my entire investment is still lying in the market. I do not have any cash in my hand at the moment. So this is the main difference between profit and cash. I can be making millions and millions of dollars of profits, but still I can have a zero cash balance or even a negative cash balance, because that profit may not be realized. That profit may be a profit which is still yet to be realized, which is not a cash thing which I hold in my hand right now. It's a bookish entry, it's a book adjustment. So these could be the reasons why a business could be profitable, but they may have actually zero or a negative cash balance also. So the cash flow coverage method is a more better way of measuring the risk. Why? Because the interest will not just be paid by profits. I have to have hard cash in my hand to be able to make the payment for the interest. So the cash flow coverage ratio actually measures that if as a business, do I have enough money in sort of cash in my hand to be able to pay the interest. So I was just giving you the example that $10 is the interest obligation and 100 is my profit. Let's suppose the cash that I have with me, my bank balance of the cash balance is $50. So I have to pay $10 and my balance is 50. So how many times can I now pay the interest using the cash that I have with me? How many times would I be able to pay the interest with the cash that I have with me? 5 times. So this is what the cash flow coverage measures. The formula is accordingly modified. We take the cash generated from the operations and we divide it by the interest expense. So this ratio will will let you people know that how many times the company will be able to pay the interest with the cash that they have with themselves. So these are the subcategories that we learn as a part of the gearing or the risk ratios. Let me know if there's anything that's bothering you in these ratios that we have learned so far. Let me know if all is good too. Then we will proceed further. Okay, great. Good to see your responses. I will proceed further now to the next category of ratios, which is also the last category, which is the investor ratios. So, investor, you all know who is an investor? The person who has invested in a company his money to earn a return is called as an investor. So, within investor ratios, these are the different ratios that we have. First ratio is the earnings per share ratio. So, as you can see, here we are measuring that per share, how many earnings has the investor actually earned. So what is the profit? The money, the profit that is left for the shareholders divided by the number of shares. Because I want to find per share profit, so I will divide it by the number of shares. Let's suppose the total profit which the business has generated is $100 million and the company has 1 million shares in issue. So that will mean that on every share we have earned a profit of $100. So this is the earnings per share ratio. It tells you that on one share, if there was one shareholder who had one share in the company, how much profit has that one shareholder made? That is the earnings per share. Then there's also a formula for the diluted EPS, even though this does not get tested in your exam. Sometimes what happens is some of the securities are actually convertible securities. What does that mean? I issue a loan to somebody that I am taking a loan from you right now, but in the future, you will have the option to either take back the money from me or you convert that debt into equity. So I have taken loan from you. I will either pay you the money back or if you do want to invest in my company, what you can do is you can convert that debt into equity. So you will become my shareholder. So now what happens is we call these securities as a convertible security. Convertible securities are also called as potentially dilutive securities. Dilutive securities means they dilute the control of the shareholders. What does that mean? Let's suppose we have a company together called as FM company and there are two owners of this company. One owner is me. So TG owns 50% of the company. And let's suppose any one out of you, maybe Aman. So Aman holds 50% of the company. So we together are holding 100% of the company. Now, what happens is we were in the need of capital. Now, what did we do is we went out to a bank and we took a loan from them. And within that loan clause, we had an agreement that either you can take back the money or if you want to invest in our company, you can have 2% of equity. So what will happen now if the bank chooses the option of taking equity in our company? The bank saw this company is doing really nice. They can make some good amounts of profits in the future. Our investment can also increase. So what the bank decided, they decided to go for the equity option. So now what happened? 2% of the company, now bank has become the owner. So out of 100, if 2 has gone to the bank, 98 are left for me and Aman. So now what will our shareholding look like? Earlier we were owning 50% of the company, but now I will own 49%. Aman will own 49%, and the remaining 2% of the company will be held by the bank. So this is how control has been diluted. Earlier there were only two shareholders. Now there are more shareholders. The bank has also now become a shareholder. So these are called as potentially dilutive securities. Why are we calling them potential? Because it is not sure that this will happen. There are some chances that this will happen, some chances that this might not happen. So just because it has the possibility of happening, we measure the diluted EPS also. So for this, the formula remains the same. You can see profit after tax minus preference dividend till here, the formula is same. Denominator is also same, you can see. And then what do we do is the potentially dilutive securities, whatever adjustments are related to those securities, those are done to find out the diluted EPS. This is something which does not get tested numerically in your FM syllabus. It's just that you people should know that there are securities that exist like this, which have the option of getting converted. If it is debt, it has the option of getting converted into equity also, and that is when we calculate the diluted EPS. Then the next category of ratio that we have is the price earning ratio. So the name itself is giving you the formula. Numerator is the price, denominator is the earning. So in the numerator, you take the share price, and in the denominator, you take the earning per share. So this is how you calculate the PE ratio. So here you see that on for earning how many dollars, how much were the shareholders willing to pay? So if I have invested $10 and I've earned a return of 2, that means the PE ratio is 5. That means the shareholders are willing to pay $5 as the share price to earn $1 of earning. This is what the PE ratio represents. Then you have some other investor ratios also. First is the dividend coverage ratio. So like how we were having the interest cover ratio, what did the interest cover ratio measure? It was measuring how many times can the company afford to pay the interest. So here in dividend coverage ratio, we will also measure how many times the company can afford to pay the dividend. So what is the money left for the paying of the dividend for the equity shareholders? That is your numerator. Denominator is the amount of dividend that you're supposed to pay. So if I am left with $100 after paying off everything, and the dividend that I'm supposed to pay is 20, that means 5 times is the dividend coverage ratio. If the company wants, they can pay the dividend to the shareholders 5 huge times. Another ratio is the dividend payout ratio. So here you're doing a comparison that out of the total profits that the company has generated, how much money have they distributed to the shareholders? So if the business has earned $150 and they have generated 50, they have given $50 as dividend. So here you will see that they have given 33% of the earnings as the dividend payout. Then a dividend yield ratio. So dividend yield ratio is basically your how much yield have the shareholders gotten in form of dividend. Do you people know the meaning of the word yield? What does the word yield mean? What's the meaning of yield? Come on, you're all students of finance. Yes, yield means return. So how much return have you earned in the form of dividends? So on the investment that you have made, you purchased the share in the company. So on the share that you have purchased, how much dividend were you able to generate on that purchase? So if let's suppose I got the share for $10 and $2 is the dividend that I have received, so that will give me 20% dividend yield. That means for $1 that I had invested, I have gotten $0.2 as the dividend on that particular investment. Another ratio that we have in the investor ratios is the earnings yield. What is the earnings yield? It is the EPS divided by the ordinary share price. You can see this is the exact opposite of the PE ratio. PE ratio is share price upon EPS. Earning yield is EPS upon the share price. So these are the inverse of each other. This ratio exactly helps you measure that over the investment that you have made. If your investment was $10 and the earning per share is $5, that means you have generated a 50% yield on your investment. So in the form of earnings, you have generated a 50% yield. These are the few ratios. And then finally, to wrap it off, the total investor ratios, how much is the total shareholder return? So shareholders can get the return from their investment in a company in two forms. Firstly, I will receive some dividend from the company. Secondly, I will receive some capital appreciation. What is capital appreciation? I'll give you people an example. Let's suppose I purchase the share of a company in the beginning of the year. So I purchased the share of the company, let's suppose for $10 at the starting of the year. Now, when the year has ended, the share price has gone up to $13. And then during the year also, the company gave me a dividend. The company gave me a dividend is equal to $1. So now, if I want to find out how much total have I gained this year, can you people let me know what are the gains that I have made this year? What are the components of the earnings that I've made this year? You have the numbers in front of you. Yes, absolutely right, Lekna. One, there's been a capital gain. The capital that I invested worth $10, now it has increased to $13. So first I have gained $3 in the capital gain, plus I got $1 as dividend. So shareholders can basically get return in the form of two ways. One is the capital appreciation and second is the dividend. So you add both of the returns. So here the return will be year-end share price, you use the formula 13 minus price at the start of the year was 10. So this gives you the difference in the capital gain plus the dividend for the year. Dividend for the year is $1. So this is our numerator. And we have to divide this by the share price at the start of the year, which is $10. So 4 will be your numerator, divided by 10 will be the denominator. The total shareholder return which we will get will come around to 40%. So this is the total shareholder return. That means in the entire year, the shareholder, including the dividend, including the capital gain, this is the amount of money that the shareholder has been able to generate from their investment. So these are all of the investor ratios in front of you. Let me know if you have any doubts. Otherwise, we are going to proceed to a numerical activity where we will practice the application of all of these ratios formally. Okay, one student is asking me to repeat the dividend coverage ratio again. So dividend coverage ratio, like I was mentioning, is the counterparty, or you can say is a friend of the interest cover ratio. So how in the interest coverage ratio we are measuring how many times can the company pay the interest with the earnings that they have. So similarly in dividend coverage, we are measuring how many times can we pay the dividend with the earnings that we have. So if you see the numerator is profit after tax minus preference dividends, which is basically the profits which are left for the ordinary shareholders, right? And you divide that by the dividend. So if let's suppose I have, after subtracting everything, taxes, interest, every expenses, preference dividends, let's suppose I'm left with $100 and I'm supposed to pay a dividend of $20. So that means I have the capacity to pay this dividend 5 times to my shareholders. So more the dividend coverage ratio, more safer is the possibility of the shareholders receiving the dividends because the company has enough money to pay them these many number of times. Okay, I hope it's clear now. Any other doubts? Please feel free, guys. Do not hesitate in asking away your queries. We're all here to learn. You will learn from me. I will learn from you. We will all learn from each other. All good? Give me a confirmation if you're all with me till here. Okay, perfect. Great. So I will now proceed further to activity one. So this is the financial statements of one company are given to us. Cathcart Company Statement of Financial Position for 31st December 2000X. So this is the balance sheet. We are given with the current assets, equity, non-current liabilities, current liabilities. We are given with the P&L account, and here at the bottom, we are given with the ratios which we have been asked to calculate. So mostly all of the ratios which we have learned over here, we have been required to calculate these ratios. So first is the gross profit margin. You people let me know what is the answer for this one going to be. We've just now learned the formula. Calculate and let me know your answers. Okay, most of you are giving me 20% as the answer. Let's see how we're going to work around. We've just learned the formula. It's going to be gross profit divided by the sales. So this will be 600 divided by 3000 into 100, which will give you 20%. So you're all correct. Now let me know for operating profit margin. You have all information in front of you. You can let me know the numbers itself if you cannot do the entire working, although these are just simple percentages to calculate, nothing difficult. What working will we do for operating profit margin, guys? I'm waiting for your answers. Be quick, this is not very difficult. Then we will move to the quiz also to wrap up this chapter completely. How will we do the working? Operating profit margin, we are supposed to take the operating profit or the PBIT and we divide that by the sales. PBIT is directly given to us 400. So 400 divided by the sales, which is 3000. So 400 upon 3000 into 20%. Solve this. How much is this going to be numerically? 13.3%. Okay. Now let's move to the third ratio where we are supposed to calculate the ROCE. What is the formula for ROCE? You take the PBIT divided by the capital employed. So we have the PBIT just above 400 we have taken. Divide this by the capital employed. You people have learned two formulae for capital employed. Use any and let me know what will be the capital employed. We can take the total assets and from that we can take away the total liabilities. The total assets are given to us as 3200. From this, take away the current liabilities of 600. So 3200 minus 600. This will be my denominator. Let me know what will be the answer. Multiply by 100 because ROCE is always expressed as a percentage. Okay. All right, 15.38%. Okay. Now let's move to the fourth one, which will be the return on equity. So return on equity, PBIT remains same, 400. Denominator will be equity. Equity is the capital plus the reserves. So we have the ordinary shares plus the reserves. So 1800 will be my denominator. This is the numerical working for return on equity. Then what will be the formula that we use for our current ratio? Let me know quickly. Sorry, return on equity, we've done a mistake. Nobody even corrected me. 600 is our, 400 is our PBIT. But for the return on equity, we take how much money is left for my shareholders. For my shareholders, I'm supposed to take after subtracting each and everything possible. So profit after tax has been given to me at 160. But 160 also I cannot take as it is because we can see in the balance sheet that there are preference shares also. So I have to also take away the preference dividend. 200 is the value of my preference shares. 10% goes away as dividend. So that means 10% of 200, which is 20, will be the preference dividend. So you take away 20 from here. This will give you 140 as the numerator, 140 divided by 1800. This will give you the final answer for the return on equity. You're all with me in this calculation? Any doubts, please let me know. Okay. Now, current assets upon current liabilities, current ratio is very easy. All totals are readily given to us. This is the total of the current assets. This is the total of the current liabilities. So it is 1000 upon 600. Then what about the asset test ratio? What do I have to do? For the asset test ratio, just subtract the inventory from the numerator. Absolutely correct. So let's see how much is the inventory given to us. Out of 1000, inventory is 400. So just add receivables and cash. This will be 600. So you have 600 divided by liabilities remain the same. This will give you the ratio of 1 is to 1. Then calculate the receivables collection period. How much will be your receivables collection period? You take the receivables balance and you divide that by the credit sales. Receivables balance is 500. You will divide it by 3000. 3000 is the sales. If nothing is mentioned, we will assume every sales is on credit. And then you multiply that by 365. So it is 500 divided, sorry, 500 divided by 6000 into 365. So this will lead to your answer in terms of the number of days. Then you are supposed to calculate the asset turnover. What is the asset turnover formula? Asset turnover formula is sales upon capital employed. So we have just calculated capital employed above. Capital employed was 3200 minus 600. And then you have to take the sales in the numerator. So 6000 upon capital employed will be 3200 minus 600. So this will give you your asset turnover ratio. This will be measured in terms of times. Whatever final answer you get, you will get it in terms of times. Then you are supposed to calculate the proportion of debt finance. So the formula that you had learned was long-term liability divided by either the equity or you can take the total of the capital employed. So we can do either way because nothing has been specified here. What is our non-current liabilities? Non-current liabilities are 600 plus 200, which will give me 800. And I have to divide this either by the equity itself. Equity total will be 1800. Or another option also, which will be marked correct, will be whatever I have as a part of my capital employed. So capital employed is all of my total assets minus my current liabilities. So both ways, whatever working you do will be marked as correct. Then we will proceed further to the interest coverage ratio. What is the formula that you people have just learned? Is my voice breaking, guys? Is it the same for everyone? Aman, please recheck the connection on your end. Okay, what about the interest cover ratio, guys? What's the formula that you people have learned? Yes, it is how many times can the company pay off the interest? So PBIT upon the interest expense. PBIT is also called as the operating profit. So take this PBIT, which is 400, divide that by 60. This will give you your interest coverage ratio. Then move forward to the EPS. EPS is earnings per share. So the total earnings after preference dividend, which we had calculated above, 160 minus 20. 160 minus 20, this is the earnings. And then you will divide it by the number of shares. How will you guys find out the number of shares? There are 1000 number of is the value of the shares, and value of one share is $1. So how many will be the number of shares? How do people work around the number of shares? Number of shares will be equal to total value divided by value of one share. So the total value is given to us as 1000 and value of one share is 1. That means the number of shares is also 1000. So what you will do is you will take the money that is left and you will divide that by 1000. So here you will get to the EPS, that will be the earnings per share. I think this is going to come around to 0.14, right? Perfect. All right. Now move to the dividend coverage ratio. Let me know your answers. Dividend coverage will be how many times can the company pay the dividend. So for that, I will need the dividend information. Total dividend that I have to pay to the shareholders is 125. How much money am I left with for the shareholders? 160 minus 20 divided by 125 is what I have to pay. So solve this numerical. What you will get will be the dividend coverage ratio. Lastly, you're supposed to calculate the dividend yield. How do you calculate the dividend yield, guys? What's the formula that you've just learned? I hope you people were making your notes. Yes, it is the dividend per share divided by the ordinary share price. So we are given with the ordinary share price here in the question itself. Let's read through the information. This is the current market price of ordinary share. $1.4 is the share price. I have to take the dividend per share. So the dividend that I have given in total is 125 and I've given it to 1000 people. 1000 is the number of shares. So that will give me how much as the dividend per share? Dividend per share will be 0.125, right? So I will divide the dividend per share by the value per share, market value per share. This will give me the dividend yield. Multiply this by 100 and always give your answer in terms of percentages. And lastly, we will calculate the PE ratio. The name itself gives me the formula. Take the market price, which is 1.4, divided by the earning per share. Earning per share, you people have just calculated, which is 0.14. So this fraction will give you your final answer for the PE ratio, which will come around to 10. Okay. So here we have solved this activity together to be able to see that are we able to use all of the formulae or not. Any queries in this activity? Okay. All right. If you're all good, then I will take you people to the last thing that we have an agenda for today's session, which is the quiz of this chapter from the ACCA Study Hub. So I'm just navigating my screen to the ACCA Study Hub. Is the Study Hub visible to everyone? Perfect. So here is the quizzes part, and here is chapter number 19. I click on start quiz, and here are the questions in front of you. Question number 1, think properly and let me know your answers. Before you give your final answer, think properly. You can drop your answers in the comment box once you are done with your thinking. Read the questions properly, then give me your answers. We are not in any haste. Livin, Umar, rethink your answers. I see some correct answers being put in the chat box. Okay, so let us discuss this together. I'm seeing a mix of responses, although majority of you are giving the correct answers. The question is asking us which of the following statements about a company with a high operating gearing is true. Just now we have learned the formula of operating gearing. I told you there are two types of gearing. One is financial gearing and one is operating gearing. Financial gearing relates to which aspect, guys? What is financial gearing all about? It's all about debt. So that means any option which pertains to debt, which is option B, you can eliminate that because we are talking about operating gearing and not the financial gearing. Operating gearing, we have learned it talks all about the fixed cost. So more the fixed cost, more is the operating gearing. So it is the first option that you see over here that is telling you change in the sales will have a relatively small impact on profits. If a business has a high operating gearing, that means the business has high fixed costs. So if fixed costs are very high, even if there is small change in the sales, will it have a small impact on the profits? No, because if majority of your part are fixed costs, then if my sales have fallen, then my profits will fall sharply because a lot of the sales portion will be going away in paying for the fixed cost itself. So it will have a big impact on the profit if the change in sales volume is there. Same thing will be there if the profits, if the sales actually increase by a very big amount. So if the sales increase by a very big amount, what will happen is my fixed costs are going to remain the same. After that, whatever money that is left will straight away go towards my profits. So both things are going to be there. Good thing, it will further be better. If a bad thing happens, if the sales drop, it will be a bad thing further on my profits. So the first statement has to be eliminated. Second statement talks about the proportion of debt finance. We are not talking about financial gearing. The question is about operating gearing. So we eliminate statement B also. Statement C says the company will have higher risk and increased return potential. This is absolutely correct. Why? Because if I have a high operating gearing, that means the proportion of fixed costs are high. High fixed costs will mean more risk. Why? Because if the sales are not going good, I may not have enough money to even meet my fixed cost also. But then there's also an upside to it. Potential for more return is there because in a good time, my fixed cost will remain the same. So the more number of sales, once I meet up the fixed cost, majority part of that sales will go towards increasing my profit and my return. So statement C has to be the correct answer. D says it has a relatively high proportion of variable costs. Had this statement told proportion of fixed cost, then the statement would have been correct because if the operating gearing is high, that means the fixed costs are high, variable costs are low. So low proportion of variable costs, then it would have been correct. Or if it would have said high proportion of the fixed costs, then the statement would have been marked as correct. So statement C is going to be our final answer over here. Any doubts? Are we all good here? I've explained you why the option C is correct, also why A, B, and D are incorrect. Is everyone with me? Should we proceed to the next question? Okay. This is question number 2 in front of you. Very easy numerical to solve. Sales has been given to you, asset turnover ratio is given to you, return on investment is given. They are asking you to calculate the capital employed and the operating profit. Let me know your answers. What's the formula that you people have studied for the for the asset turnover ratio?
ಇಲ್ಲ ಒಮ್ಮೆ
Yes, it is sales upon capital employed. So sales are given to you. That means if I take the capital employed to be X, so 1.5 million divided by X is equal to 2. So if I want to find out the value of X, X will be equal to 1.5 million divided by 2, which will be $750,000. Right. So our answer has to be either option B or option C. Then we are also supposed to calculate the operating profit. For return on investment, what is the formula that we have learned? It is operating profit upon capital employed. So the capital employed, if I have calculated as 750,000, my profit will be 6% of 750,000. What is 6% of 750,000? Have your calculators ready with you? It is 45,000. So that means our answer is going to be option B. Are you all with me? Should I proceed to the third question? Okay, great. I love the participation from you people. Great. Let's have a look at question 3. Here we have been asked to calculate the dividend yield. So G company paid an interim dividend of 0.06 per ordinary share in the middle of the year, and they declared a final dividend of this much. That means two times dividend was paid during the year. One time in October, another time in December. And the ordinary shares are trading at a cumulative dividend price of 1.83. Do you people know the meaning of cumulative dividend price? This is one concept which we usually learn further in the equity chapter. By any chance, does anyone know the meaning of cumulative dividend price? Not adding the dividend for the whole year, but dividend which is just about to be paid, that is added in this price. So 1.83 includes 0.08. So if I want to find out the share price, it will be 1.83 minus 0.08. So how will I be doing my working over here? Um, So if I have to show it to you on a calculator, the share price which is actually there is 1.83 minus 0.08. This is the share price that I will be using in my denominator. If I want to calculate the dividend yield, the formula that we have learned is dividend upon the share price. So you calculate the total of the dividends 0.06 plus the other dividend is 0.08. So in total, this is the dividend that is paid divided by the value of the share, which is excluding the dividend. So that was 1.75. So this is going to be your dividend yield. So answer will be option D. This is a concept, even if it's not completely clear to you, it's totally okay. You will understand this concept better in the equity chapter. I don't know why they've put in this question over here, but once we do this concept in the equity chapter, then it will probably make more sense to you. So even if you're not 100% clear with it, it's totally fine. We will learn about it in more detail in the chapter to come there. All right, should we proceed further? Okay. So here is the second last question for the day. Very easy again. Total shareholder return has been asked from you people. Be very careful, read the question properly. Samanvai, Levin, think about your answers again. What is the formula that we have learned to calculate the total shareholder return? We have learned that we take firstly the difference between the share price at the start of the year and the end of the year. Current share price at the end of the year is 1.62. That means shareholders, how much have they gained in terms of capital? They have gained 1.62 minus 1.47. So on the share price, 0.15 is the gain that they have made. And then they will also receive the dividend, which we take as the part of the total shareholder return. So if I want to take the dividend, quarterly dividend of 0.02 per share is paid. So every quarter I am paying this much. How many quarters are there in a year, guys? 4 quarters. So you will multiply the dividend per quarter by the number of quarters. So 0.02 into 4. This is the dividend that has been in total paid. And then we had calculated the difference. The difference was 0.15, right? So this is the total return on how much investment? Investment at the beginning of the year was 1.47. So here you are going to get 15.6 as your final answer. So we will select option A over here. Any doubts? Is this understood by everyone? Did you realize where you people were going wrong? What was the mistake that you were selecting the other options? B, C, and every other option? Okay. Now let's proceed further to the last question. Which ratio provides investors with a measure of the risk of not receiving the dividends? Read the options carefully and then let me know your answers. Last question for the day. I'll set you free after this. Just think carefully about this one. As an investor, you are facing a risk that you might not receive the dividend. Think carefully. Any other answers? I will need reasons for this. Okay, Umar and Shaivari are saying C. Can you people give me a reason for this? Why is it the option C which should be the answer, guys? Okay, so let me discuss in case you're not able to come up with the answers. Here, the question is asking you which measure of risk is something which will measure risk of not receiving the dividends. So it is the dividend coverage ratio, absolutely correct, Umar. It is the dividend coverage ratio which measures can the company pay me the dividend or not? Does the company have ability to pay the dividend to me or not? So if the dividend coverage ratio is lesser than 1, that would mean that the company has declared the dividend for sure, but they do not have enough profit to pay that dividend. So here I will be facing a risk of not receiving the dividend that the company has promised to me. So it is the dividend coverage ratio which will measure for the investors the risk of not receiving the dividends. Okay, clear, guys? Is this understood by everyone? Okay, all right. So with this, we are through with chapter number 19 completely, and we are done with the quiz also. Now, it goes without saying that your homework for this session, the next time that we meet, you people are supposed to practice these OT revision questions. These are 7 questions in the practice portion of the study hub before you people come up for the next session, which will be day after tomorrow, same time, and I'll share the link with you people over WhatsApp. So ensure that you do this as a part of the homework so that you keep your practice along with the concepts so that when it comes till the later stages of the preparation, the entire load of practice does not get onto your head all in once in a bulk quantity. Do simultaneous practice. With this, you will keep revising the concepts, you will not forget the things, and at the same time, you will be getting the benefit of practice. So this is your homework. I'll see you people the next time. Next time we will be continuing further with our syllabus. We will go back to chapter number 1. and then ultimately we will proceed further with our syllabus. I hope that today's session was helpful and you people were able to follow through. In case there was anything that you would like me to inculcate in the following sessions, anything that we can do better, you can let me know and I will see if it is possible to work around that way. I will surely try to incorporate your suggestions also. Regarding all of the resources, I will be sharing over the WhatsApp group after this session. Okay. All right then. Bye bye, guys. Good night. I'll see you the next time.